Hi all, good afternoon and welcome. I am Ridhil Mishra and on behalf of CareEdge, I welcome you to our today's discussion on credit quality assessment for first half FY24. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. We have with us Mr. Rajiv Sabharwal, Managing Director and CEO at Tata Capital Limited. Mr. Sandip Ghose will be joining soon, Managing Director and CEO, Birla Corporation Limited. Mr. Ramkumar Ramaswamy, Chief Financial Officer at Jindal Steel and Power Limited. Mr. Kailash, Vaswani, Chief Financial Officer at Renew Power. The session will be moderated by Mr. Sachin Gupta, Executive Director and Chief Rating Officer at CareEdge Ratings. We will commence the session with a presentation by Smita Rajpurkar, who is a Director at CareEdge, which will be followed by a panel discussion and finally the Q&A session. In case of any queries, participants are requested to please key in your panel. We'll take up your queries in our Q&A session. Now, may I invite Smita to make a presentation, please?
Thanks, Mridul. Good afternoon, everyone, and a warm welcome to CareEdge Ratings webinar on credit quality assessment for the half year ended September 23. In this webinar, we will take you through our assessment of the credit quality of CareEdge Ratings rated portfolio in the first half of the fiscal, which we believe would give an overview of how Indian corporates have performed in the clouded global economic landscape. The global economy has been clouded with moderate growth, elevated inflation, and interest rate hikes. Have the Indian corporates stood strong amid these global challenges, or have they started to face the heat of the global uncertainties? Let us deep dive into the performance of our rated portfolio to get answers to these questions. Let us first have a look at the key highlights of our today's presentation. If we see the global growth, it is projected to moderate to 3% in 2023 from an estimated 3.5% in 2022 as per the International Monetary Fund. The global slowdown has now started to pinch the Indian corporates, and India's merchandise exports are getting affected. Also, trade deficit has shown signs of widening in the recent months. Despite this, India's economic growth accelerated to 7.8% in Q1 of FY24 from 6.1% in the previous quarter, and the high-frequency economic indicators that we will have a look at later in the presentation also depict resilience. CareEdge Ratings credit ratio, that is, the ratio of upgrades to downgrades, has moderated in this backdrop to 1.67 in the first half, down from 2.72 seen in H2 FY23. While there is a moderation, upgrades still continue to outnumber downgrades with 217 upgrades and 130 downgrades during the half year. If we look at the sectoral trends during this half year, the credit ratio for manufacturing and services sector dipped to 1.38 from 2.69 in the second half of FY23. The credit ratio of the infrastructure sector continued to remain strong at 2.21 in H1 FY24, though moderating from 3.10 in H2 FY23. The credit ratio for the BFSI sector exhibited a sharp upswing to 4.20 in H1 FY24 from 1.91 in H2 FY23. Going ahead, the cumulative impact of interest rate hikes, volatile crude oil prices, and geopolitical risks remain the key monitorables. So while the numbers have depicted a moderation, CareEdge Ratings still believes that the Indian corporates have been on a steady course. Let us now have a look at the global challenges that we just talked about and how India has demonstrated its resilience amid these. The global growth is projected to moderate to 3% in 2023 from an estimated 3.5% in 2022, according to the IMF. Global growth outlook thus remains weak, with 2023 GDP growth trailing well below the historical annual average of 3.8%. If we look at global inflation, it is projected to moderate to 6.8% in 2023 from 8.7% in 2022. However, if we were to consider this against the pre-pandemic level of 3.5%, it is still elevated. Further, global inflation, though moderating, it is still above the central bank targets, hence signaling that the interest rates would stay high for longer. In the September policy meeting, the US Fed opted to keep the policy rate unchanged, but offered a hawkish guidance, indicating one more rate hike in 2023 and fewer rate cuts in 2024. Similar policy stance was taken by the Bank of England, while the European Central Bank hiked rates for the 10th consecutive time. Interest rates globally are thus expected to remain high for some time now. Post-COVID, the global supply chains have normalized. However, China's weak economic recovery and the consequent weak demand in China are keeping global commodity prices muted. Also, this hints at a situation of a demand-supply mismatch in China and thus higher level of exports from China to other countries. Crude oil prices recently soared to their 10-month high, with Brent crude moving close to $95 a barrel. The global economy thus remains clouded, and the key monitorables in the view of CareEdge ratings would be the volatile crude oil prices, Chinese exports, further interest rates hikes globally, and the geopolitical risks. In this backdrop, let us now see how the Indian economy has performed on the various indicators. India's GDP rose by 7.8% in Q1 FY24 from 6.1% last quarter, aided by a supportive base, healthy services growth, and sustained momentum in manufacturing and construction sectors. However, in the coming quarters, we expect GDP growth to moderate due to base normalization, and accordingly, our full year GDP growth projection is at 6.5% for FY24 as against 7.2% in FY23. If we look at the inflation numbers, CPI inflation is high at 6.8% in August on account of elevated food prices, while core inflation is moderated to 4.9% YOY in August. India's high-frequency economic indicators, which we will observe in the coming slides, also point towards healthy economic activity. While the domestic economy has stood steady, the weak global demand has started to hit exports, and the trade deficit has shown signs of widening in the recent months. Overall, the healthy domestic economic activity and comfortable current account deficit signal resilience in the domestic economy. However, resurfacing of inflationary pressures, especially on food, weather-related uncertainties, and external spillovers remain the key watch-outs. Now let us have a look at India's high-frequency economic indicators as we had discussed earlier. In these charts, we can see the index for industrial production, that is IIP, and the purchasing managers index, that is PMI. As we can observe, the IIP accelerated to a 5-month high of 5.7% in July 23 from 3.8% in the previous month. The chart to the right shows that our manufacturing and services activity has continued to put up a strong show, with PMIs continuing in the expansion zone, that is above 50 levels. Moving on to two more important high-frequency economic indicators, that is GST collections and e-way bills generation. We can see in the chart at the left that GST collections have remained upbeat, staying above rupees 1.6 lakh crore for the 7th consecutive month in September. They had in fact touched 1.9 lakh crore in April 2022. On the right, we can see that the e-way bills generation has also remained robust, consistently breaching the 8 crore mark since November last year and touching 9.3 crore in August 23. Now let's look at the credit growth trend. The chart to the left shows us the long-term trend of the bank credit growth. We can see that it has risen sharply from its lows of about 5% during COVID times, peaking to over 16% in October 22 and hovering around 15 to 16% since then, signaling to a healthy growth in the bank credit offtake. However, if we dissect this growth into sectoral cuts, on the right-hand side chart, we can see that the bank credit growth, considering data up to August 23, is led by the services sector, which includes credit to the trade and NBFC sector at almost 21%, followed by the personal loan segment at 18% year-on-year in FY24. Credit growth to industrial sector was muted at over 6% YOY in FY24. Looking at how the exports have performed, so merchandise exports have been recording contraction since February this year owing to weak global demand conditions. The chart to the right shows that trade deficit has widened to a 10-month high of USD 24 billion in August, after averaging around USD 19 billion in the preceding 4 months. We can thus say that the global slowdown has started affecting us, but despite that, the domestic economy is holding up well with robust high-frequency economic indicators and strong credit growth. In this backdrop, let us now understand how the performance of our rated portfolio has been in the first half of FY24. In this chart, we can see how CareEdge Ratings credit ratio, that is, the ratio of upgrades to downgrades, has performed over the past 10 years. The credit ratio is continuously on an uptrend from its low of 0.49 in H1 FY21, which was the pandemic period, up to H1 FY23 when it peaked at 3.74. The credit ratio then moderated in H2 FY23 to 2.72 and further to 1.67 in H1 FY24, which is the period of our study, wherein CareEdge Ratings reported 217 upgrades and 130 downgrades. The long-term average of our credit ratio for last 10 years is around 1.5, and hence we can say that the credit ratio at 1.67 is normalizing and getting closer to the long-term average, which is in line with our expectations. Let us now get a little deeper to understand the buildup of the credit ratio across portfolio cuts. Here we can see that the credit ratios for both investment grade, that is IG, and below investment grade, that is BIG, or alternatively also referred to as sub-investment grade entities, saw a moderation in H1 FY24. The investment grade entities are entities enjoying ratings of CARE BBB minus and above. In the chart, we can see that the credit ratio of below investment grade portfolio plunged down from 2.22 in H2 FY23 to 1.18 in H1 FY24, pulling down the overall credit ratio. While the credit ratio for the investment grade entities also saw moderation from 2.99 in H2 FY23 to 1.98 in H1 FY24, it remains strong, indicating that the investment grade portfolio has exhibited higher resilience. So with a ratio of close to 2, we can say that the investment grade portfolio has seen around 2 upgrades for every downgrade in the H1. This chart gives us a deeper understanding into the rating category-wise proportion of upgrades and downgrades of the entities reviewed during H1 FY24. So for example, if we see the AA category entities, 10% of the entities reviewed in the AA category were upgraded, while 3% saw downgrades, and the balance 87% of the entities were reaffirmed with no change in their rating. We can here see that the CARE AA, A, and BBB rated entities witnessed significantly higher number of upgrades as compared to the downgrades, while the CARE BB and B category entities saw relatively lower gap between the proportion of upgrades and downgrades. So essentially, the higher rated entities depicted resilience and stood strong. This slide shows us the percentage of upgrades and downgrades to the total rating actions over the years. In this chart, we can see that the normalization that we saw in the credit ratio in H1 FY24 is primarily driven by higher proportion of downgrades in the rated portfolio in this period, increasing from 5% in H2 FY23 to 9% in H1 FY24. The percentage of upgrades to the total rating actions have dipped only marginally from 15% in the earlier half to 14% in H1 FY24. From the past few slides on our rated portfolio, we can say that CareEdge Ratings credit ratio is on a normalizing trend and is pulled down primarily by higher proportion of downgrades, essentially in the sub-investment grade portfolio. Now, after seeing how the ratio has performed across rating categories, let us analyze the sectoral trends in our credit ratio. As we can see in the slide, the CareEdge Ratings credit ratio of the manufacturing sector and the infrastructure sector normalized, while the credit ratio of the BFSI sector witnessed an upswing in H1 FY24. The manufacturing and services sector saw the credit ratio moderating from 2.69 in H2 FY23 to 1.38 in H1 FY24, mainly driven by high proportion of downgrades in this sector. While the credit ratio of the infrastructure sector also saw a moderation, it continued to remain strong at 2.21 in H1 FY24. Credit ratio of BFSI sector saw sharp upward momentum with a credit ratio at 4.20 in H1 FY24 from 1.91 in H2 FY23. We'll now briefly take you through the subsectors that drove the credit ratios within these broad sectors, our outlook on these sectors, and key monitorables on the credit side. Let's start with the manufacturing services sector. In this slide, we can see two charts. The left-hand side chart shows us the trend of the credit ratio, and the right-hand side chart shows us the proportion of upgrades and downgrades in the entities reviewed by us in the last 3 half years. As we can see in the right-hand side chart, the moderation in the credit ratio in H1 FY24 is mainly driven by high proportion of downgrades in the sector, increasing from 5% in H2 FY23 to 10% in H1 FY24. Upgrades in the manufacturing and services were witnessed by entities within the investment grade category. while most downgrades in the sector were witnessed by small and mid-sized entities having inherently weaker credit profiles, with many of them being export-focused. We can see in this chart that healthcare, auto, and auto components, iron and steel, and real estate sectors saw high proportion of upgrades than downgrades. On the other hand, export-linked sectors like chemicals, textiles, and pharmaceuticals witnessed higher downgrades during H1. Despite the normalizing trend seen in the credit ratio, the credit quality of the manufacturing sector is expected to be stable on the back of sustained domestic demand, government spending on infrastructure, and envisaged benefits of schemes such as production-linked incentives. Corporates with leaner balance sheets will continue to exhibit resilience. However, subdued global demand may impact some export-focused sectors, albeit China plus one sourcing strategy of global players is expected to cushion the impact to some extent, while likely fructification of free trade agreements with key nations can expand the horizon for India. Overall, our outlook for the manufacturing and services sector remains stable. Let us now move on to the infrastructure sector. The credit ratio for infrastructure has remained strong at 2.21 in H1 FY24, with upgrades significantly outnumbering downgrades in the past 3.5 years. Also, around 50% of the downgrades were in the sub-investment grade category in H1. The key identifiable drivers for the upgrades were commissioning of projects, especially in the hybrid annuity model segment and solar power generation space, benefits of the Atmanirbhar Bharat schemes providing a fillip to power companies, refinancing of projects at better financing terms, enhanced execution pace along with strong order inflows in construction and transport infrastructure, and improved liquidity profile for EPC companies. On the flip side, non-compliance in statutory requirements adversely impacted financial flexibility with few players. This chart shows that the transport infrastructure segment saw significantly high number of upgrades compared to downgrades, followed by power sector, while construction saw similar proportion of upgrades and downgrades. Our outlook on the infrastructure sector also remains stable. In the transport infra sector, we expect that the revenue visibility will be enhanced with infrastructure pushed by the government, with transportation segment driving growth in awards. We further expect toll collections to grow by 12% in FY24, supported by favorable movement in a WPI and traffic revival. As far as the power sector is concerned, thermal PLFs are likely to remain steady at 60%. Implementation of EMI scheme is the key enabler for improvement in collection efficiency, and renewable tariffs are expected to rise but shall remain competitive vis-a-vis conventional power. On the flip side, there could be execution-related challenges, and key credit monitorables would remain regulatory uncertainties in certain states and increase in input prices and interest rates. With respect to the construction sector, the EPC margins are expected to recover from FY23 levels with addition of orders at new rates and reduction in commodity prices from peak levels. Moving on to the BFSI sector, post-COVID and the related asset quality concerns, credit ratio for the BFSI sector crossed unity for the first time in H2 FY22 after a period of 3 years. Subsequently, with the sector demonstrating improvement in asset quality and strong equity capital raising abilities, credit ratio rose to 4 in H1 FY23. The credit ratio, though witnessed a moderation in H2 FY23, stood strong at 1.91, and in the current period of H1 FY24, it peaked to 4.2. The strong credit ratio during H1 FY24 is driven by improved profitability, with most of the players in NBFCs scaling up the businesses and strengthening the capitalization through fresh equity mobilization. Credit ratio improvement of banking players during this period was driven by sharp improvement in NIMs, supported by hardening interest rate environment, improved asset quality, and capitalization metrics. We can see here that both banks and NBFCs have driven the credit ratio in H1 FY24. Banks saw 17% of the portfolio getting upgraded in H1 FY24, while there were no downgrades in banks in the last 3.5 years. 10% of the NBFC portfolio witnessed upgrades in H1 FY24. We have further tried to delve into the reasons for upgrades in the BFSI sector and analyzed the broad drivers. Here we can see that the upgrades in the banking sector can be equally attributed to improvement in asset quality and capitalization. NNPA for the banking sector is at its lowest ever level of 0.9% at the end of Q1 FY24. Further, continued capital support by the Government of India to the PSU banks has also strengthened their balance sheets. Upgrades in NBFCs can be attributed to the strong business performance supported by continuous scale up and resultant improvement in profitability, strengthening capitalization, and upgrade in parent ratings resulting into upgrades in entities which are part of the conglomerates. We'll now discuss our overall outlook on the BFSI sector. So, the credit growth in banking sector has remained strong in FY24 YTD at around 15%, and the banking sector is expected to witness credit growth of around 13 to 13.5% in the whole year FY24. Major growth drivers are likely to be retail loans followed by services segment. Profitability of the banking sector is expected to witness slight moderation in FY24. With public sector banks now catching up with their private sector counterparts with continued improvement in asset quality, the NNPA percentage is poised to trend towards the downwards in the next few quarters. Despite rising interest rates, profitability in mid-sized NBFCs is protected due to optimization of OPEX, moderated increase in interest rates, and lower credit costs. In this backdrop, the credit outlook for the BFSI sector is expected to remain stable. With this, we come to the end of our presentation and we will sum up our observations. Indian corporates have exhibited a steady performance despite the global challenges with a normalization in credit ratio in H1 FY24, which is in line with our expectations. India's high-frequency economic indicators point to healthy consumption demand, thereby signaling resilience in the domestic economy. India's GDP growth is expected to moderate due to base normalization in the coming quarters. Nevertheless, India still remains one of the fastest growing major economy. In this backdrop, the credit ratio in the near term is expected to remain range-bound. We will, however, remain cautious of global issues like volatility in commodity prices, geopolitical risks posing headwinds for global growth, and the demand-supply mismatch in China, which may lead to dumping to the other countries, including India. On the domestic front, subnormal monsoons affecting rural demand, resurfacing of inflationary pressures, especially food inflation, and external spillovers on the Indian corporates remain the key watchouts. To conclude, corporate India has indeed demonstrated resilience amid global challenges, but we continue to remain cautious. In the presentation today, we have broadly highlighted the key credit drivers and our sectoral outlooks. For a more detailed coverage on each of the subsectors, please refer to our full report, which we will be releasing on our website after the webinar. Thanking one and all for a patient hearing, handing over to Mridul. Thank you.
Thank you, Smita. Dear participants, you are requested to please key in the questions anytime during the session. We'll be taking up the questions at the end of the panel discussion. Now, may I invite Mr. Sachin Gupta to take over the session, please. Sachin is the Executive Director and Chief Rating Officer at CareEdge Ratings and has over 23 years of experience in leadership positions across the credit rating business. Prior to joining CareEdge, he worked as Senior Director at CRISIL and managed the corporate and infra ratings. Over to you, sir.
Thanks, Mridul, and thanks, Smita, for a fairly detailed presentation. Let me welcome all the panelists. We indeed have quite an illustrious panel today. So I will start with a quick introduction and then we will get into Q&A. I'll start with Mr. Rajiv Sabharwal, who's the Managing Director and Chief Executive Officer. He has over 31 years of experience in the banking and financial services industry, and he has been acknowledged for his contribution to the growth of the retail banking and real estate and housing finance market in India. He's also served on committees of RBA and IBA. He also had successful stints with ICICI, True North Managers, Sequoia Capital, CareEdge Group, SRF, GE Capital, and Times Bank. Mr. Sabharwal is a BTech from IIT Delhi and PGDM from IIM Lucknow. A very warm welcome, Mr. Sabharwal. Then we have with us Mr. Sandip Ghose. He is the Managing Director and Chief Executive Officer of Birla Corporation. He earlier served as the Chief Operating Officer in the same company, and he's an experienced business leader, well-known media personality. In a professional career which has spanned over 40 years, Mr. Ghose has held a variety of leadership positions in industries ranging from FMCG, media, and now cement. Mr. Ghose is a qualified chartered accountant with an All India merit rank. A very warm welcome, Mr. Ghose.
Thank you so much.
Thank you. Then we have with us Mr. Ramkumar Ramaswamy. He is the CFO at Jindal Steel. He's a seasoned finance professional and brings with him a rich and varied experience of over 25 years across multiple business divisions, including sales and marketing, supply chain, financial planning, and treasury. Mr. Ramkumar's diverse industry experience spans across FMCG, chemicals, oil and gas, metals, minerals, and natural resource. A very warm welcome, Mr. Ramaswamy.
Thank you, Sachin.
And finally, we have with us Mr. Kailash Vaswani. He's the Chief Financial Officer at Renew Power. He has worked in the financial market since 2001. And in 2011, he joined Renew as a founding team member to help put the business plan in place. And it enabled Renew with the first round of capital raising from Goldman Sachs. He has significantly contributed to the growth of the company through organic and inorganic additions. Mr. Vaswani is an experienced professional with a demonstrated history of working in the renewables and the environment industry. He's a strong finance professional with leadership training from Harvard Business School. A very warm welcome.
Kailash. Thank you so much. Thank you.
Thank you. So great. So, let me start. It was kind of a fairly detailed presentation trying to cover the whole corporate across the sectors and all that. The big message that I kind of, we can take is that, yes, there is a bit of a moderation in terms of number of upgrades coming down, number of downgrades going up. But broadly, we seem to be, on the course. One thing which kind of clearly stands out, and I'll like to get Mr. Sabharwal in it, for the first question, is the asset quality. Because at the end of the day, the upgrades and the downgrades are also talking about the credit quality, right? And when the other metrics of credit quality is also the asset quality of the financial services system. And there again, we are seeing that the asset quality across the banks and NBFC is, pretty good, is kind of all-time good and all that. While some bit of it could be because of aggressive write-offs, but still, both in private sector banks, public sector banks, and NBFC, we are seeing NPAs at a very low level. The question, sir, is this sustainable? Is it that people were a little bit more risk averse and therefore they were not taking the risk, and now, once they are, a bit more confident, they will take more risk and then the asset quality will worsen? Or is it more structural? Over to you, sir.
I think it's a combination of number of factors, Sachin. It is true that when COVID came in, everybody became a little more conservative. So the portfolio which got created soon after, the economy started opening up, I think that portfolio which got created has turned out very well because everybody had gone conservative and the credit quality which they were putting on their books was better. Also, what has happened is a fair amount of deleveraging has happened within the corporates, which has also allowed for credit quality to improve. There were a couple of schemes which came from the government, ECLGS scheme, which allowed for more credit to be given, which was government guaranteed. That also gave more, I would say, space to SMEs to carry on their business, even when some of their financials were not as good. So that also helped, things to come back to normalcy faster. We also saw that individuals did, fair amount of savings during that period, during the COVID period. And some of that has actually helped them borrow more and repay some of their debts too. In fact, once COVID opened up, we were seeing a fair amount of prepayments happening at individual levels, which means that they were also deleveraging to an extent. All of that has changed of late, where leveraging seems to be going up slightly. But I believe that these were some of the structural things which really helped credit quality improve. There were other things also which helped improvement in recoveries, structural changes which happened in the legal framework, which allowed for recoveries to become better. So all of this has helped bring down credit costs to, I would say, the lowest I have ever seen. And in fact, the last 2 years have been just too good, I would say, for the credit quality. Now, whether this will be sustainable in the future, I think we've seen probably the best credit quality in the last year or so. I don't think so it's going to get better than that. It will, slightly worsen from that, but I believe it will still be far better than the pre-COVID times. So on credit quality, we don't need to worry at this point of time. I believe it will continue to be better than what it was in the pre-COVID times, but it will be worse than last year because last year was just too good on credit quality. And when we are seeing growth coming back and disbursements growing, I think some of that will reflect in credit quality over a period of time, but still much better than what it was in pre-COVID times. And I think we can focus more on the growth at this point of time.
Great. Thank you, Mr. Sabharwal. And in fact, when we are talking to a lot of other NBFCs as well, we are seeing clearly that the focus on growth is there, and some of them are actually growing very fast. So, and I also hope that the impact on asset quality as the balance sheets become bigger is certainly lower than what it has been in the past for at least some segments. Let me get in, Mr. Sandip Ghose. On the cement side, cement was one sector which actually did not have such a great last year, right? I mean, they were, especially in terms of the pricing pressures, which kind of the industry had to really bear, and then also the price hikes were not as much. We are seeing a turning of the tide in the current year rather, and wherein I am told that the demand is quite strong and the pricing has also kind of improved. And cement is kind of quite a core segment, and the financial health of cement sector always is critical for the growth of entire infrastructure and all that. So in that backdrop, Mr. Ghosh, how do you see the sector playing out? And also in terms of the pricing power, can we say that the pricing power has returned to the cement industry?
Thank you so much. I like to put in, always in this discussion, I try to put in context when people talk about last year not being good. What one has to remember through the COVID period, cement is an industry which did remarkably well, contrary to expectation. And some of it was due to factors which were not anticipated. One was with all the money pumped into the rural economy and people having returned home, during the lockdown, the rural activity was very strong. And that's why cement, if you see, during that period, did very well. What happened last year, obviously, was the entire shock of the Ukraine war and the fuel prices going out of whack. Now, that is something in that situation, the industry was obviously not able to pass on that level of cost increase, and they had to absorb that pain given the overall economic context. So what you saw last year in terms of profitability obviously was not a normal situation. It is only after the third quarter when oil prices started cooling off, coal prices and everything started cooling down, but still to get the full impact wanted to go into the fourth quarter. Now, having got there, I think the industry was kind of catching its breath. They could not have really tried to upset the apple cart when things were returning back to normal by trying to exert price pressure. But also what had happened, if you recall, at the end of the last fiscal, the second half of last fiscal, the industry went through a major restructuring. And those restructuring efforts were still to fall in place, and dynamics were still playing out, not only among the bigger two major players, but also among the other big players who were trying to get their act together and position themselves for the future. So there were at least two more people. I can take names as Sri and Dalmia. They were also trying to. So all these things created, I think, a little bit of a stir in the market. I wouldn't call any kind of instability or any sort of a price destruction. But it went through that phase before I think the industry can now look at exerting some degree of pricing. Not, I wouldn't call it power, but to now get back to the normal of what it ought to have been, given the overall, whereas fuel prices have come down, other costs have gone up. Things and those one has not been able to pass on to the market. And I again keep emphasizing cement is an industry which is, I think, much maligned for so-called exerting pricing power. If you see the normal in a normalized way over the years, cement price increase has been very, very nominal. It is not. It has gone up and down in spurts, but if you normalize the curve, it has been one of the most sedate price curve you'll see among comparable industry. So now I think it is getting in there, but I don't see, demand being healthy. There is going to be a runaway pricing situation. You will get the corrections which the industry, I think, was overdue for 2 years. Last year, it got hit by the fuel prices, as I mentioned, and therefore the normal other costs could not be, passed on, and then the regular costs have kept on increasing even this year, and so those corrections will take place. But I don't see either. Sometimes people talk about, again, this overcapacity, people setting up more capacity, and whether that would lead to any kind of price destabilization. I neither see that happening, nor do I see, exceptional price corrections. Yes, I'll just take a minute more. You have seen pockets, certain things like Eastern market. You saw in the last 2 months there has been significant price correction, and that is because earlier, due to very localized factors, Eastern market had gone through huge dip in prices. They had to correct that. You may see that sort of correction coming in South for the thing, but I don't see overall on a national level growth will be double digit, but prices you won't see a huge spurt.
Great. I think that's very encouraging. A double-digit growth in cement. I think that also indicates in terms of an overall growth in the infrastructure and other overall GDP. So great. Thanks, Mr. Ghose. I'll get in Mr. Ramaswamy. The one of the common themes that we are hearing now, and even which was alluded to in the presentation, is threat of China. In terms of China being China is slowing down. That's what people are saying, even though the data every month kind of keeps doing a little bit of up and down. But with the scenario that it will not be growing at 8 to 10% that it used to, and they have huge capacity, say even in the your sector, steel sector. The concern is that could it be that they start selling which they cannot sell domestically in China, and therefore impact Indian steel market. And B, also when Indian players are looking at export, lately there is a whole narrative of steel players looking at international markets, US, Europe, and all that. So if China's capacities are relatively unutilized, could that kind of impact the Indian steel players both domestically and in the export market? Over to you, Mr. Ramaswamy.
Thank you, Sachin. I think there are a few underlying questions, in that single question that you asked. So let me try and kind of share my reflections on that. I would maybe like to talk about 3 or 4 themes. Yeah. First is, and all of this has to be contextualized. So first is, I think it's important to understand the domestic steel growth that's currently happening in India. I think it is very, very important. So maybe I'll start with that, and then I'll talk about steel exports from India. I think what does the basket of steel exports look like? Because again, we cannot have a single broad brush on this. There are niche, specialty, differentiated products, and then there are commodities as well. So let's talk about the steel exports. Thirdly, I'll touch upon the China story. I think all of that is there in the public domain, but I'll give a view of how we look at it in steel. I'll also briefly touch upon the steel imports. In terms of while we're talking of imports from China, I think the larger basket of imports actually happens from the FTA countries. The Japan, Korea, ASEAN. So I'll give a quick overview on that, and lastly, just round it all up by sharing how are we seeing that actually playing out in the business. Maybe and I'll do all of this very, very briefly. In terms of the domestic steel growth, last year the steel consumption grew by around 13%, driven by the infrastructure spending in the country, and we are seeing similar trends this year as well. So I think this is largely driven by the government spending on infrastructure, and we are seeing that actually reflecting in our order books on a month-on-month basis, on a quarter-on-quarter basis. This is a very, very positive story. When you look at the large steel producing countries, India is maybe the only one which has such a strong domestic consumption growth that is reflecting. And it's important to understand that in the context of the question that you just raised in terms of what is happening in China. The second is exports. So if you look at it on an average, we are exporting around 7 to 8% of the total steel production from the country. JSP is slightly better. We are around 10 to 12%. The way we look at exports is essentially not just as a percentage of the portfolio, but are we really delivering? Are we gaining value from the exports? We want to finally, we are all in the business of making money, and we go by where the value is. Now, currently, if you look at it, a large portion of the value actually is in the domestic growth story. However, where we have differentiated products, where we have markets where we have strong competitive advantages, vis-a-vis China or other countries, those are the areas where we try and maximize. So if we have a differentiated plate offering that goes into an infrastructure business, or we have a market where we have a very strong competitive advantage, or China has barriers in terms of duties or anti-dumping duties, etc. I think we try and maximize value over there, and that is how we have been doing it for the last couple of years. So I think our exports would be largely driven by the value that we see and the advantage that we're able to bring to us on the table and also to the customers. In terms of the China steel story itself, of course, China is the largest steel producer and consumer in the world. Due to the slowdown in their economy, the Chinese consumption, the domestic consumption of steel, has degrown consecutively for more than 2 years. This year, we are seeing a positive growth. We are seeing a 1% growth. And our expectation is that in the second half of the year, the Chinese economy will improve. Traditionally, there have also been production cuts that happened during the winter seasons over there. So we expect some of the the surpluses available for exports also to moderate over the second half of the year. We'll have to wait and watch how all of these play out. But again, as I said, our strength is a very, very strong domestic consumption story. Our strength is the differentiated offering that we would be offering to the customers. And lastly, on the steel imports into India, as I said, it is not so much China which is a threat, but the FTA countries, Japan, Korea, the ASEAN countries. China, of course, it'll have a bearing on the realizations, because if they are in a desperate position and they start selling at lower prices, it will have a bearing on the international steel prices. However, if there are instances of anti-dumping, etc., happening, we are confident that proactive policy action will be initiated. So I think that has been demonstrated in the past. Now, how is all this playing out? If you look at it, our volumes have been holding very, very strong. Our order book has been very, very strong. Our realizations from what it was in the beginning has also significantly strengthened. You would have seen that in the steel realization. So on the ground, I would only like to summarize and say that it is a very, very positive story, strong demand driven by domestic infrastructure spending.
Got it. Thank you, Ramaswamy. And it's very nicely you kind of put it. And the key number that I take out of it, two key numbers. One is that we are looking at a 13% growth last year and this year, which again, steel being a core sector for us indicates an overall growth in the economy. And secondly, you said that our dependence on export is only 7-8%. Maybe for some countries, some companies it would be higher. So it's not that. We largely still a domestic driven thing, and as long as the domestic growth continues to be strong, we should kind of be doing good. Let me get in, Kailash. Kailash, one thing which people are really looking at is in terms of this whole geopolitical scenario, tensions, global, sovereign level stresses and all that. Infrastructure in general, is kind of a little bit more, has kind of got a lot more equity funding, both in renewable and in roads, that we've seen a lot of transactions happen. Now that we're seeing globally, there is some kind of a slowdown which we are fearing, which is happening, and obviously the money is getting more expensive and all that. In that backdrop, do you feel that the Indian infra story, would get affected, and therefore the amount of capital or the access to capital the Indian players had would be restricted, and therefore could limit our growth going forward?
Okay, thanks, Sachin, for the question. Again, my personal view here is that the access to capital that most Indian infra developers have is very diversified, and they're not reliant only on one pool of capital or one investor class, because of which any sort of move can have that impact. If you would have asked me this question 10 years ago, yes, that time a lot of sovereign capital was coming into the country. But given the entire transition story, especially in the energy sector that we are seeing, it's not just sovereign capital which is coming into projects in India. It's capital is coming from across the world, mostly from oil companies and all, which are also looking to invest into this space. Moving to the debt side of things, there again, the interest rate increase has made the borrowing costly. But a trend which is playing out right now, that the investors in the global bond market especially are sitting on cash, earning treasury yields of 5%, and would deploy that capital only if they get a risk premium on top of it, which is sort of a little expensive at this point in time, given that
Right.
we are able to borrow from the domestic markets at much lower rates. That's why we are not going into that market, but there is no dearth of capital which is there. So capital is definitely available in abundance. Closer home, I think, as far as the infra story in India is concerned, I don't see any change in that because of higher interest rates, because in a way the domestic market is quite deep and is able to finance a lot of these assets. The domestic debt market is obviously quite liquid, and there is bank loans, NBFCs, bond markets which is available. And on the equity side also, there is a lot of capital which is available, and companies are able to raise more capital. We've seen how much the IPOs are getting sort of oversubscribed in the Indian context. So that entire theme which has got discussed in terms of during COVID, there was savings which resulted in a lot of capital being retained in the country, and that's sort of enabling a lot of sectors to really outperform despite all the sort of headwinds that we're facing in the global markets.
Got it, Kailash. No, I think it's interesting. I mean, especially the thing that you mentioned, that oil and gas companies are actually, and I do remember some of the deals wherein, so they obviously are making a lot of money. So they all of them want to go clean. So I think that it would be a natural choice for them, even more so going forward, to kind of invest in the Indian renewable energy assets. So
Absolutely.
that's helpful. So great. So let me get you back, Mr. Sabharwal. One of the things, while last year we said, and continuingly now, asset quality is good, and the growth has been there. One of the things which has surprised me personally the most is the asset quality of the unsecured loans. This is the segment which earlier a lot of NBFCs used to shun away because of the historical reasons, some, high delinquencies, etc., which were generally there. But now we are seeing this space is kind of, again, even in unsecured personal loan space, small ticket loan items, buy now, pay later, all sorts of things are there. And we are seeing reasonably strong asset quality. Now, you being a banker and run multiple businesses over a period of time, how, with your experience, how are you seeing it? If I were to request you to look forward, can this story continue in terms of high growth with superior asset quality continuing, or you seeing some asset bubble kind of building in, or some risks kind of going unnoticed?
Yeah, I think when we talk generically, we don't get the right answer. I think we will have to look at each entity separately. What has worked very well for the financial services business is the fact that if your risks are well diversified, if your book remains granular rather than lumpy, then that business continues to do well. The other thing which is also very essential in our business, because our business is all about risk management, there is nothing beyond that, is this that you need to have enough tools and data available with you so that you can know early signs of challenges which are coming in.
Right.
So early indicators have to be in place, and you need to give heed to those early indicators. So and make changes as and where it is necessary.
Right.
As long as you do that, I think it is fine. So there are companies, there are entities who have an unsecured book which is less than 20-25%. There are of the total book. There are entities whose unsecured book is higher. There are entities who have bulky exposures in sensitive sectors, and there are NBFCs who don't have. So I think what is very essential is that if you have your unsecured book in a proportion which is manageable, you are paying heed to early indicators in case there is a problem and taking corrective actions,
Right.
you will be able to do well. While
Right.
if you don't do that, then there will be a challenge. You know why the regulator has been worried of late, and they have expressed it explicitly, is because of the fact that the growth in this sector has been very high.
Right.
So if the growth is very high, then the general feeling is, are all controls in place? Are we missing out something or not? And if we look at how the portfolio has been performing, and if we look at the data which comes from the bureau, what it is telling is that while generally unsecured loans continue to do well, there is some amount of stress which may be getting built either on the card side or
Right.
in the small ticket digital loan side.
Right.
But beyond that, the portfolio continues to do well, and all indicators don't point to a problem. So as long as you can manage and not be present in these sectors which are giving some early signs, or you are taking corrective actions to control those delinquencies, you will be fine. So there is no one generic answer one can give.
Right.
The
Right.
only generic answer is, have enough early indicators to tell you what you should do and what you should not do.
Correct. Correct. I got it. I think it's something we will see how it unravels. But right now the numbers, because people run with an estimation that this kind of a loss will be there. Right now those level of losses are not coming through, so the profitability also looks a little overstated to that extent. Maybe we will, maybe the cycle will turn, and then we will see more.
And you know it very well. If the denominator grows very fast, then
Exactly.
what
That's
you
the
need to
other
look
thing.
at
Yeah.
is more of lagged and vintage
Back then.
numbers.
Yes. 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 Okay, I'll get in Mr. Ghose now. In terms of capacity, we discussed about pricing, and you gave a very good answer in very detailed thing. But do we see that the expectation of the growth may lead to of very healthy growth can lead to or is leading to large capacity additions, and that can kind of impact, because cement being kind of a commodity play. Uh, is that kind of a fear or a risk that you see panning out in the next, say, 2 to 3 years post elections? Because election year generally you have large kind of demand kind of coming in, but post elections could there be a overcapacity kind of a scenario?
See, the point is, if you dissect the demand, okay, there is certainly the demand is coming from, I would say, primarily when you talk of elections, etc., you talk of two things. You talk of infra, spends on infra, and spends on rural infrastructure, which essentially means all the welfare schemes of your Awas Yojana and the rural roads, etc. But the good part now is you're seeing also traction, say, in housing. The housing industry is showing traction. There is again industrial capacities are coming in. So uh, all the other indicators, to leave these aside, those are also looking positive. And whether you call the new investments which are coming into the country post COVID, China, etc., and more importantly, some of the less developed regions, or they are playing the catch-up game for a variety of reasons. Apart from the government policies, I think there is, thanks to GST and everything, there is now a more even distribution happening, and so there is a natural growth happening in that area also. So even if, assuming for a moment, post-election, certain things were to taper off or taper down for a while, I think the growth prospects remain very healthy for this sector for times to come over there. What what people need to be watchful about is, I think, one is, so far Indian industry has been insulated from imports. Now, there are, one hears talks about people bringing in clinker along the coastline and from the Gulf areas. That is one factor which will come in. And the second factor could be, sooner than later, I think there would be some changes in construction technology. And that might impact overall, but that is slightly longer term. I don't see an issue in 2 to 3 years. And there is always also a difference between announcements and actual commercial. So that lag you need to factor in. So I wouldn't be too worried about demand tapering off when you're having an oversupply situation in the coming 2 or 3 years.
Got it. Got it. Thank you. Thank you so much. Let me get in, Mr. Ramaswamy, in terms of, I think just beginning of this month, we have this European carbon tax, which has been levied. Is that something, and, I'm just taking it as a pointer, globally, other sectors could also see this, and, especially from an export perspective. Is that something that India should be worried about, considering that our supply chains are not as green as maybe what European, procurers of these commodities would want them? While we are certainly taking steps, but there may be some distance for us to reach there. So do you see that as a risk, more in general? Obviously, steel is there, but even otherwise.
I would not categorize it as a risk. I mean, that is a reality. I mean, all of us have commitments of moving to green steel or transitioning to net zero. And I think these are some of the measures that are taking us towards that direction. Now, the only way I look at it is not going to be one single big bang event where everybody starts producing green steel from the next day. It's going to be a series of initiatives that the entire industry is working on. I think each of us have our roadmaps. There are various initiatives, from coal gasification to carbon capture, utilization and storage, to green power, to supply chain efficiencies, etc. So I think there are various initiatives that are underway, and that is reflective of all the companies in India and also in the similar regions as well. So I think it is a story that will evolve, but there are public commitments that all of us have made, and I think therefore what we do not see this as a risk, but we see this as a reality that all of us need to adapt to. Sachin.
Got it. The good thing is that at least India is working towards green hydrogen. So in that sense, for steel manufacturers, they will have a possible backward linkage into, if they were to use the green hydrogen path. Okay, Absolutely. Let me just take the last question before we open it up for the the audience questions, and this is for Kailash, yourself. Whenever we talk about renewables, the biggest risk that people see generally is the weak counterparties, and we have seen in the past, how some of the state discoms would just not pay, or pay with 6 month, 9 month, 12-month delays. And then we saw there was a change last year, wherein there was this, judicial intervention, and then there was an EMI structure that was then. How is it playing out? Because there were these 12 EMIs. Are we seeing that is it a problem of past, or is it's only kicking the can down the road, which a lot of times it kind of is the reality?
Yeah, at least we would hope that it's not just kicking the can down the road. What gives us some confidence this time round in terms of the way the scheme has been structured? Okay, and it was done in a very methodical manner. First, the government came out with LPS rules. Then they allowed the discoms to take loans under the state guarantees from PFC-REC. And then there was also the launch of the Prapti portal. No, so the Prapti portal is quite a useful tool because as part of that portal, the discoms have to submit a proof of payment, and only if they submit proof of payment against every invoice is when they are able to buy the energy from the exchange. Otherwise, there is complete barring which happens of energy access from the open market in case there are overdue payments which are still going on. And that has sort of put in this discipline because we upload our invoices, and then once we get the proof of payment, it's marked received. Then the access to the energy exchange is possible because again, most discoms do like to have some part of the power which they buy from the open market. And again, it's mostly not necessarily a choice. Sometimes it's just a requirement because of the difference in load which may happen on a period to period basis. So that really is working. I think the state governments have also ended up, were given the ability to borrow beyond their capped limits for the purpose of discom borrowing. So that has also again helped. So we are hoping that this will continue into the long term. Investor appetite also hence has increased. So lenders are now more freely financing discom assets, and so is it. We also have an asset recycling program. So as part of that, also we are seeing enough interest in distribution company-based assets.
Got it. Thank you. We will now request Mridul, can you please make the announcement for the questions from the audience?
Sure, sir.
I can see a few which are already logged in, so I will kind of start with that.
Yeah, dear participants, begin a Q&A session. In case you have any queries, you please request it to key in the panel, please.
Okay, one question that I have is in terms of the low, and maybe Mr. Sabharwal, you can take it. It's basically on the low. In one of our slides, we saw that the credit growth to the industry, the banking credit growth to the industries is very low. So, in terms of how do you see that playing out going forward? Is that something that, are we seeing any changes or any positive green shoots there?
I think Sandip or Ramkumar or Kailash can answer it better. But what has happened up till now actually is retail has driven the growth far more than the wholesale side. However, for the last, let me say, 6 to 9 months, we are seeing a fair amount of brownfield investments happening in the manufacturing space. People are expanding capacities, adding more lines. Renewable is obviously totally different. There, everything is fresh, and there is fair amount of investments which are happening in that space. But as far as manufacturing is concerned, I think we are seeing good signs over the last 6 to 9 months. And but how future will play out, I think Ramkumar and Sandip can, answer that better.
Yeah. Mr. Ramaswamy, you want to take actually both Ramkumar and Kailash, they are both continuously, I'm sure, borrowing. They are one of them are setting up a large plant in Kailash. So I think it's continuously in an investment mode, all the new projects. But yes, I think maybe I'll tweak it the other way around. I mean, in terms of the bank's interest in lending to you, has that, and Kailash also referred to it in terms of the discom risk and now lenders being. So maybe we can say how keen the banks are, to kind of lend to you. Are you seeing some change in their mindset, and also obviously at a very fine rates?
Let me answer this in 2 ways. First is what is our appetite to borrow, and the second is what is the bank's appetite to lend. I think as we have, gone through the cycles, and therefore we have now taken a fairly conservative position that we want to have a very, very low debt in our balance sheet. Most of the expansion we would like to do through our internal accruals. So to that extent, we don't want to get into a mode of excessive borrowing. That is our position. So that's our appetite as well. And what we've been doing over the last few years is our investments have kind of matched the operational cash flows that we've generated. That is how we've been managing the balance sheet. Now, ironically, always, when you don't need money, that is when the lender's appetite is the maximum. Of course, with our improved credit ratings, etc., I think we do clearly see a lot of appetite to lend to us. We have had unstructured, without collateral loans being taken. So I think the appetite is quite high. But again, it would be a reflection of the company's balance sheet, the metrics, the financial metrics that the company is able to maintain. So I would kind of link it to that, Sachin. But as I said, our appetite is to not borrow much, because we are a commodity business. We want to have a structurally very resilient balance sheet. So that's the way we are looking at it.
Got it. Kailash, you want to add?
Yeah, sure. Again, from our perspective, yes, we remain in investment mode, sort of continuously. What we've seen is that the appetite in the domestic market has really increased substantially, more so among the PSUs, I would say, because they were sort of absent from the entire renewable energy financing, which was happening in the last 5-7 years. And now, they are obviously through with their merger, the restructuring, the balance sheets are much stronger. And now they obviously distinguish between, conventional power and renewable energy projects, and are now more comfortable with the risks surrounding the RE projects. So we've seen a lot of the PSUs really stepping up and looking to finance many projects. We are seeing oversubscription happen in our projects where we have 2-3 different types of financing for the same project, and then eventually we have to go with whatever the best option in the long-term interest of the project. But yes, appetite is definitely much higher.
Correct. One related question, Mr. Sabharwal, I just thought I will pose to you. In general, we are seeing a lot more interest of the financial institutions, including the banks, to tilt their balance sheets more towards the retail assets. So while, yes, there is a demand also, but I think they are also very consciously moving away. And there are some examples I would not like to name, but some banks, some large NBFCs, they decidedly moved away from the corporate and the infrastructure space, maybe because of the mishaps that may have happened. Do you see that changing? Because where I sit or I look at, I think that, and we also discussed about asset quality being very good. Actually, this is the time when the banks and the NBFCs should be taking exposures to the corporates because of the stronger, the bankruptcy laws, because of overall improved structural things as we discussed before. But somewhere I feel that there is a move away. Your thoughts, sir?
Sachin, I don't think so. In reality, that is true. You heard what Ramkumar mentioned. You heard what Kailash mentioned. Actually, if they are asking for X monies, they probably have 4X the bids for those, and they have to choose, what they need to do. So it is more of the prudence which probably corporates are trying to exercise at their end. I don't think so for good projects. There has been any dearth of money. Now, you may talk about certain corporates which are overly leveraged, where there are challenges. That I think so is prudent for bankers to, be more cautious on that front. But I don't think so there is a single good project which will come up in India and there won't be 5 lenders fighting to get a share of that.
Got it. I think that is, you're right. So it's largely, the ball, you've put the ball back in the corporate court. You should have projects, you should have, need for credit, and we will be,
Sachin, you showed it in your presentation, the ratio for investment grade versus non-investment grade project. There was a big divergence.
Correct. No, I think you're right. Yeah. So as long as the project is in the investment grade, I think there will be appetite from the BFSI sector to really fulfill that. So great. So I think we have a few more questions, but we are running a little short on time. We are already exceeded by 10 minutes. So I would like to bring this to the event to a close. And thanks a lot, Mr. Sabharwal, Mr. Ghose, Mr. Ramaswamy, and Mr. Vaswani. It was a pleasure talking to you. We had, very diverse areas of this kind of a conversation. Always tough. We are covering multiple industries, economy, everything. But I think we did do some justice to this, and thanks a lot to our audience to come and participate in this. Mridul, over to you.
Sure, sir. Thank you, sir, for moderating the session, and again, Smita, for your presentation, and to all the guest speakers for the insightful views. It was a privilege to host you. And for all the participants for taking your time out and being a part of this CareEdge webinar. For any further feedback, suggestions, you are please welcome to write in the suggestion mail, which will be coming no sooner the webinar ends. I request the tech team to log off, please. Thank you very much.